Joining me now, Bianco Research President Jim Bianco. Jim, right now the fear index is calm, but when it eventually moves, obviously it will go higher at some point. Is there a number, a line where you start to say, okay, maybe it's time to make changes to the portfolio?
Not necessarily a number per se, but more along the lines of if it was to start to rise, without the stock market falling, because the VIX tends to move in opposition of it. So if the stock market keeps going up and the VIX goes down, that's not a problem. If the stock market goes down a little bit and the VIX goes up, that's not a problem. But if the stock market goes down a little bit and the VIX goes up a lot, that's a problem. So it's kind of a tricky kind of measure to read. But right now, it's not giving us any kind of a yellow or red flag.
And I guess velocity also matters as well, right?
Yeah, it does, because the VIX does measure, the rate of change in the market, and so the rate of change does matter as well, too.
I want to go back to July 23rd. You and I were talking, and essentially I said, listen, you got dumb money piling into the market. Wall Street was short the market and everything else. Of course, smart money bears versus dumb money optimists. I said, at the end of the year, who's going to be the winner? You took the latter. This is verbatim of what you had to say back then. And so the reason I'm bringing this up is at some point Wall Street's got to get on the bandwagon. Either that, they've got to, if they stay bearish and stay wrong, they risk losing a lot more credibility.
They do, and I think that they are losing credibility. And the problem that Wall Street is facing that retail doesn't have is the majority of the stock market gains since ChatGPT came into existence in 2022 has been in the AI and AI-related stocks. Now, if you're a good Wall Street person and you've passed your Chartered Financial Analyst, series, you look at those stocks and you say they're overvalued and there's a lot of risk, and you've kind of underweighted them or avoided them, and you've missed out. Retail doesn't think of the market that way, and they chase those. So for the moment, it is working for retail, and you're right. Wall Street has to figure out what they're going to do about these AI stocks because they're afraid to play them, but if they don't play them, they can't, give decent performance.
Of course, everyone's hoping that, no one ever rings the bell at the top, right? But you did post this story of this woman. We did this segment yesterday who's charging $30,000 to name other people's babies. Of course, there's another good story out there. Hedge fund managers now hiring agents. And I don't think a day goes by when we don't see these sort of obscene amounts of money being spent on obscure things. But it's not a timing mechanism, right? So there's excess out there.
Yes, but I've also heard that she offers a volume discount for twins, so it's not as bad as you think it is right now.
Okay.
But yeah, you're right. This is these excesses. What these excesses are is around Silicon Valley, because she's in San Francisco, and around hedge funds, which suggests that stock market gains have become so great that people have more money than they know what to do with. And then you start seeing this kind of conspicuous consumption because of it. And that's kind of a worrisome sign that maybe we've gotten a little ahead of ourselves. But you're right, it's not a timing tool. Just because we've become aware that this is happening, it could continue to happen for years. But it is definitely a sign that, the market is getting a little bit frothy because people are making too much money too fast.
Hey, I got 30 seconds to go, but I want to squeeze in a Fed question for you. Beginning of the week, Dallas Fed President Lori Logan, she published a piece somewhat critical of the rate cut, saying she wasn't convinced about the labor market being that weak enough. But since then, we've got a plethora of more data that suggests that the labor market is indeed worrisome. My question to you, it feels like at the Federal Reserve, there's been a line in the sand drawn, one group on one side, one group on the other side, and that worries me.
Yeah, to some extent, healthy debate is not a bad thing over at the Fed.
Right.
But the line in the sand that has been drawn, I think when it comes to the labor market, is about immigration and about the population growth of the country. If there's no immigrants coming into the country, and the population growth right now in the United States might be the lowest in about 80 years, go back to the 1940s to find the last time it was this low, we might not need to create that many jobs. And this is really where the issue comes in. Maybe 22,000 to 25,000 jobs a month is enough. You don't need it if you don't have population growth. And if the population growth was all immigrants coming into the country and the borders closed, we might be fine with that many jobs. But a lot of people are very uncomfortable with that. And that's really where the push-pull is. How many jobs do we need to create? And no one has a real good handle on it. And that's why you're seeing lines in the sand being drawn which way at every rate.
Hey, Jim, always great having these conversations with you. Thank you so much, my friend. Appreciate it.
Thank you.
All right, folks, now the overall market.